There's a stretch of water off the coast of Iran that is, at its narrowest point, about 21 miles wide. Shipping lanes inside it are 2 miles across in each direction, separated by a 2-mile buffer. Through that gap, before this year, roughly a fifth of all the oil consumed on Earth passed every single day, along with a fifth of the world's liquefied natural gas. No pipeline, no railway, no alternative route carries anything close to that volume. That's the Strait of Hormuz. For most of the last decade, that fact sat in the background of the global economy, acknowledged by analysts, priced quietly into shipping insurance, and otherwise ignored by everyone else. This year, it stopped being background. Between February and June of 2026, the strait went from a theoretical choke point to an actual one, closed, mined, and fought over. And even now, with a ceasefire technically in place, it has not gone back to what it was. That's what I want to walk through today. What actually happened, why the risk didn't end when the shooting stopped, and what that tells us about how fragile global energy logistics really are. Before we talk about the current crisis, it's important to understand why the Strait of Hormuz matters so much in the first place. The geography explains nearly everything. This narrow waterway connects the Persian Gulf to global markets and serves as the primary export route for some of the world's largest oil and natural gas producers. Iran controls the entire northern coastline, while Oman and the United Arab Emirates border the southern side. Countries including Saudi Arabia, Iraq, Kuwait, Qatar, the UAE, and Iran all depend heavily on this single maritime corridor to move energy exports to customers around the world. There are a few alternatives, but they're limited. Saudi Arabia can redirect part of its crude through pipelines to the Red Sea, and Oman can export some shipments without passing through the strait because of its location. For most other Gulf producers, however, there is no practical substitute. If shipping through Hormuz is significantly disrupted, large volumes of oil and liquefied natural gas cannot simply be rerouted elsewhere. They are delayed or halted altogether. That's why military planners, energy analysts, and governments have viewed the Strait of Hormuz for decades as one of the world's most strategically vulnerable choke points, where a regional crisis can quickly become a global economic problem. On February 28, 2026, the United States and Israel launched coordinated strikes against Iran under the name Operation Epic Fury, targeting military facilities, nuclear infrastructure, and Iranian leadership. Iran's supreme leader, Ali Khamenei, was killed in the operation. Iran responded with missile strikes on Israeli cities and on American bases across the Gulf, including in the UAE, Qatar, and Bahrain. Within 48 hours, the strait had, in practical terms, shut down. Iran's Revolutionary Guard Corps didn't need to build a physical blockade to achieve that. They issued warnings forbidding passage, they boarded and attacked merchant vessels, and they laid sea mines. On March 2nd, an IRGC naval official put it bluntly on record. The strait was closed, and anyone attempting to pass it would face consequences. By March 4th, Iran had formalized that position, later carving out exceptions for vessels from countries it considered friendly. A handful of Malaysian ships, for instance, were allowed through in April. What made the closure effective wasn't just Iranian military action directly. It was the insurance market. War risk premiums for ships transiting the strait had already been climbing before the strikes, from roughly 0.125% of a vessel's insured value to as much as 0.4%, which for a very large crude carrier meant an additional $250,000 per transit. By May, the numbers had become almost abstract in scale. More than 1,500 vessels and over 20,000 mariners effectively stranded in and around the Gulf. Tanker traffic that had run at roughly 138 vessels a day through the strait falling to near zero. Here's where this stops being a military story and becomes a purely economic one, and I think it's the most analytically interesting part of the whole episode. When a major choke point closes, it doesn't just raise the price of oil globally, it redistributes revenue in real time toward whoever can still sell without using that choke point. An analysis comparing shipping data before and after the closure found that the two biggest financial winners were the United States, which saw export revenue rise by roughly $50 billion, and Russia, which saw a steady export volume translate into an additional $15 billion in revenue simply because global prices had risen sharply around it. Every Gulf producer that had to route oil through Hormuz, Iraq, Kuwait, Qatar, the UAE, saw their export revenue fall. The two Gulf producers with a way around the strait, Saudi Arabia through its Red Sea pipeline and Oman through geography, actually saw revenue increase because they could sell into a higher priced market without paying the same risk premium everyone else was stuck with. And Iran itself, sitting on the one shore that could still move oil at all when it chose to, continued exporting throughout. Tracking organizations identified over 80 million barrels shipped from Karg Island alone during the conflict, generating billions in revenue for the same government prosecuting the war. That's the part worth sitting with. A choke point closure isn't a uniform shock. It's a sorting mechanism. It rewards proximity to alternate routes and punishes dependency. And in this case, it happened to reward the two governments, Washington and Moscow, that are geopolitically furthest from the crisis itself. By late June, a ceasefire between the United States and Iran had taken hold, and oil prices, which had spiked to a wartime high above $188 a barrel, came down sharply, trading back near $70 to $72 a barrel by early July, close to where they'd been before the war started. If you only looked at that number, you might conclude the crisis was over. That conclusion would be wrong, and here's why. Shipping executives and commodity strategists are explicit about this. Traffic through the strait has not returned to anything like pre-war levels, and it's not expected to for some time. War risk insurance remains elevated. Mine clearance concerns haven't been fully resolved. And critically, the ceasefire terms themselves are unclear enough that shipping companies are treating the peace as fragile rather than settled. One shipping investment executive summarized it plainly in late June. Even with more vessels moving, the industry is nowhere close to where it was, and he does not expect Iran's position to revert to what it was before the war. That last point is the structural shift worth understanding. Before this conflict, Iran had essentially no formal say over what transited the strait. Its international waters under a UN convention, and the norm for decades was unimpeded passage. That norm has been broken, not necessarily by law, but by demonstrated capability and precedent. Iran has shown, concretely, that it can shut the strait to commercial traffic without needing to win a war to do it. Analysts at BNP Paribas and elsewhere now describe Iran's ongoing leverage over the strait as a live issue for oil markets, not a settled one, with some suggesting Iran may seek an informal toll or coordination arrangement rather than relinquishing that leverage outright. Whether or not that materializes formally, the psychological and pricing effect is the same. The market now has to price in the possibility of another closure, in a way it simply didn't before February 2026. Two other effects are worth naming specifically because they don't show up in the oil price alone. First, the Red Sea and Suez route, which had been slowly recovering after the October 2025 Gaza ceasefire, collapsed again. Houthi forces resumed attacks on commercial shipping the same day the US-Israel strikes on Iran began, and the major carriers rerouted back around the Cape of Good Hope, adding roughly 2 weeks of transit time and substantial fuel cost to Asia-Europe trade. That means the disruption wasn't confined to Gulf oil. It touched container shipping, consumer goods, and manufacturing supply chains simultaneously through a completely separate but related choke point. Second, OPEC's position in the global market has structurally weakened. Oil production across OPEC member states fell more than 30% during the war. The UAE formally left the organization on May 1st. Combined with a security environment that no longer looks like the stable one OPEC built its production quota strategy around for decades, the organization's ability to manage global prices going forward is genuinely diminished, independent of anything happening in the strait itself right now. If you want a short list of what tells you whether this risk is receding or building again, here's what I'd track in order of how quickly they move. Watch tanker transit counts through the strait, which shipping tracking organizations publish regularly. That number, not the oil price, is the real-time gauge of whether the market genuinely trusts the ceasefire. Watch war risk insurance premiums specifically for the Hormuz route. Insurers reprice faster than politicians make statements, and a premium that stays elevated is the market's honest assessment of risk, regardless of what officials are saying publicly. And watch whether any formal coordination or toll arrangement between shipping and Iranian authorities emerges. Because if it does, that's confirmation that Iran's wartime leverage over the strait has become a permanent structural feature of the region, rather than a temporary wartime condition. Here's the broader point I want to leave you with. For decades, the global economy treated freedom of navigation through the Strait of Hormuz as close to a law of nature, something so reliable it barely needed pricing in. What 2026 demonstrated is that this assumption was a policy choice enforced by deterrence, not a physical guarantee. Once that deterrence was tested and the strait was actually closed for months, the world learned that it could be done, and that lesson doesn't unlearn itself just because a ceasefire was signed. That's why the risk premium on Hormuz isn't going back to where it was, even if the price of oil does. Markets are very good at forgetting price spikes. They're much slower to forget demonstrated capability. And that gap between a headline oil price that looks calm and an underlying risk structure that hasn't actually reset is exactly the kind of mismatch worth paying attention to, because it's usually where the next shock comes from. I'll see you in the next one.